All right, let's dive right in. If you're an accounting specialist, think of this as your practical implementation guide for the new 2026 chart of accounts. We're going to build a smarter, more compliant structure, so let's start by talking about a frustration I think we can all relate to. So let me ask you this. Are you constantly fighting with your current chart of accounts? I mean, are you seeing those dreaded, chopped-off descriptions, wrestling with compliance issues, and just getting headaches from those old, flat accounting structures? If you're nodding along, well, you are definitely in the right place. Because today, we're going to unpack the new 2026 structure. It's really all about three things: giving you absolute clarity in your reports, making sure you have airtight compliance with standards like US GAAP, and putting you back in total control of your financial data. Okay, check this out. This is a perfect side-by-side of the problem and the solution. On the left, you've got the old way. DPRN, furniture and fixtures O. What does that O even mean? Office, owed? Who knows? But look at the right. The new structure gives you the full, crystal clear description. No more guesswork, no more ambiguity. And, this isn't just about making things look tidy. US GAAP is really clear that financial statements cannot be misleading. And honestly, those truncated names, they often fail that test. This new template completely solves that by giving you all the space you need for full-text descriptions, which is absolutely crucial for audit transparency. The new structure also has this really elegant visual hierarchy built right in. Just look at the example. The main account, bank cash, is in all caps, but its sub-account, petty cash, is in regular sentence case. It's a super simple formatting rule, but it creates this incredibly intuitive parent-child relationship in your reports. It makes the trial balance so much easier to scan and understand. And that parent-child logic unlocks this really powerful idea called account compression. See, in the old flat systems, you'd run out of account numbers in a category super fast. But by nesting the details in sub-accounts, you free up whole blocks of primary account numbers. Think of these freed up ranges as a strategic buffer. It gives you this massive runway for future growth without ever having to mess with your core structure. It's brilliant. Now, let's switch gears and see how this amazing structure handles equity. This is where it gets really powerful, because one of the best features of this new chart of accounts is how you can tailor the same core framework for totally different types of businesses. So we're going to look at three really common setups: the sole proprietorship, the LLC, and the nonprofit, or NGO. Each one has its own unique rules for handling equity, and you'll see how the 2026 structure handles all of them perfectly. First up, the sole proprietor. This one's the most straightforward, right? The owner and the business are legally the same thing, so the equity section is nice and simple. You've got one account for contributions, that's the money the owner puts in, and another for draws, the money the owner takes out. Clean, simple, and does the job perfectly. Okay, but for an LLC, the details really start to matter. We never use words like stock or shares. For an LLC, an auditor would call that a dialect error, and that could raise some serious red flags. Instead, we talk about member units. And as you can see here, you can easily create Class A for voting members and Class B for non-voting members. It's precise, it's professional, and most importantly, it's legally correct. And then we get to a nonprofit, and the whole vocabulary changes again. Here, we follow the FASB standards, which means we get rid of the word equity altogether and replace it with net assets. Then you break those down based on donor restrictions. So you'll have an account for funds without restrictions for general use and other accounts for funds that are restricted for specific projects. This just shows how compliance is literally built into the DNA of the account structure itself. All right, let's move on to our third section: how we handle tax accounts. Now, this might sound a little basic, but getting this part right is really the hallmark of professional bookkeeping, especially when we talk about managing tax liabilities, even for pass-through entities. And that brings up a really common question I get all the time. For a pass-through entity, like a sole proprietorship, the owner is the one who pays the taxes personally, right? So why on earth would we track those tax liabilities on the business's books? Well, there are three really solid reasons. First, it's the only way to get a true gross-to-net picture of how the business is actually performing. Second, it's just smart cash flow management. It forces the business to set aside the cash to cover the tax burden it generated. And third, it creates a perfectly clean audit trail, which makes bank recs an absolute breeze when those tax payments finally go out. Now, to do this right, you need to be specific. We're not talking about one generic taxes payable account. No, you need separate granular accounts for federal, for state, and for any specific local taxes, like the California franchise tax.
This is the level of detail that really separates amateur bookkeeping from professional, audit-ready financial management.
Okay, let's pull all these threads together. In this last section, we're going to do a direct, side-by-side comparison so you can really see just how flexible and powerful this system is when you put it into practice.
This slide just says it all. Look on the left, a California LLC. Its equity is tracked with members' capital, it has a specific liability account for the state's franchise tax, and it's all built to comply with California Form 568. Now look at the right, a nonprofit using the exact same framework. But here, equity becomes net assets, the financial focus is on the change in net assets, and compliance is all about FASB standards. It's the same logic, the same engine, just perfectly tuned for two very different vehicles.
So what does this all boil down to? It's this, right here. This new structure provides the granularity needed while maintaining a high standard of professional reporting. It's designed from the ground up to be both incredibly detailed and impeccably professional. You really do get the best of both worlds.
So once you get this implemented, your chart of accounts is no longer just some boring list of numbers. It becomes a clean, compliant, and genuinely powerful tool. It's totally audit ready. So the only question left for you is, what financial story will it tell?